Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I like to interview him every couple of months for updates on the oil and natural gas industry. He's been writing a oil and natural gas investment newsletter, a bunch of different ones actually, for over 20 years. Very good track record. He was way ahead of the curve on the deep water offshore Guyana discoveries for Exxon Mobil. Elliott Gue, thank you for joining me again.
Oh, thanks for having me on the show.
And Elliott, you're the founder and chief analyst over at the Energy and Income Advisor with Roger Conrad. I work with you both in the past at Investing Daily. We're recording this interview on Friday, November 10th, 2023. For our listeners out there, the West Texas Intermediate crude price has corrected a little bit in the last month or so. It's down to $77.17. Brent crude is at $81.43. I want to get your thoughts at the big picture for oil and energy on the supply and demand side. Do you think that oil demand has collapsed? Because a lot of the hedge fund managers, we're hearing recession. A lot of people are shorting oil, saying that there's too much supply coming online, demand's collapsing. What are your views on this?
The view out there is that demand is weakening, and a lot of that honestly has to do with a single number that comes out of the Department of Energy's, the Energy Information Administration's, weekly inventory report, which is the product supplied number for gasoline. I think that too much is being read into that number. That number, which is considered to be an indicator of demand for gasoline, is notoriously volatile and prone to subsequent revisions. And if you look at the report that comes out of the EIA every week, they have, they tell you how much inventories have grown or declined, right? And also individual inventories like in Cushing, Oklahoma, which is an important one. They also have measures for how much oil is being fed into refineries, how much oil is being produced in the United States, how much imported, how much exported. And rarely do all the sources of demand and supply match up. And so they have what's called an adjustment factor or a balancing factor to make demand and supply equate. And when those numbers are consistently high, as they have been in recent weeks, it means that something's being miscounted somewhere. So I feel a lot of the weak demand or the weak demand, gasoline demand numbers we've seen over the last several weeks, it's probably just down to errors in the way the Department of Energy collects this data. It's all based on surveys of companies and models. So just like the monthly employment number, for example, from the Bureau of Labor Statistics is often subject to massive revisions a few months down the line, these numbers are prone to error and revision. I do think that over time, if we do go into a recession, which I believe we will ultimately, you will see, some weakening in demand. But the fact is that this cycle is a supply cycle, not a demand-led cycle. Throughout history, oil prices are determined by some combination of supply and demand. But in every cycle, one of those two tends to dominate. And this cycle, it's really more about the supply side of the equation than it is about the demand side of the equation. The last time that we saw that is the 1970s. So I think there's a little bit of a recency bias going on among a lot of investors out there and a lot of people trading oil, a lot of hedge funds. The last 20 years, when we've had a recession, oil prices have gone down, at least temporarily. Sometimes it's a very short, fast decline, such as we saw in 2008, followed by a recovery. Other times it takes a little longer, but you usually, such as in 2001, for example, but usually there's some sort of a correction in oil. Go back to the late 60s or the early and mid 70s. We had recessions and commodity prices, all commodities really, in general, if you look at an index like the Bloomberg Commodities Index, they actually accelerated to the upside during the recession. So commodity prices often actually started rallying even faster once the US economy and the global economy slipped into recession. And the reason for that is that it was led by supply. It wasn't a matter of demand growing or weakening. It was a matter of there just not being enough of these commodities to meet demand. And then as now, the reason is mainly a lack of investment. A lot of people credit, for example, the Federal Reserve under Paul Volcker in the early 80s with jacking up interest rates and bringing down inflation. And certainly that was an aspect of it. But if you think about it, for oil, oil prices didn't come down in the early 1980s necessarily because interest rates were high. They came down in the early 1980s because there were a lot of new sources of non-OPEC supply out there. We had Cantarell in the shallow waters of Mexico. We had the North Slope of Alaska. We had the North Sea of the United Kingdom and Norway. These were all discoveries made in the late 70s and early 80s that started to grow non-OPEC oil production in the late 70s. And that new supply from non-OPEC countries broke the cartel's vice grip on global oil supply. And that's what really pressured oil prices and commodity prices generally to come down in the early and mid 80s. There was just more supply. And right now we're in a position, I'm afraid, very much like the early 70s, where we've been through a long bear market in oil prices, a long bear market in many different commodity prices that ended in 2020, 2021, depending upon what commodity you look at. But in that long period of low prices, there was very little investment in new supply. That was further hampered by ESG and, in the case of oil, environmental considerations that caused companies to be reluctant to invest in, major new oil and gas projects around the world. And as a result, once again, OPEC is in the catbird seat. They have control over global oil supply. They're the swing supplier again. So you look at company like Saudi Aramco or a country like Saudi Arabia, while a lot of Western companies and countries were talking about, well, we don't need more oil fields. We don't need to bring new supply online because demand has already peaked, right? We've got, electric vehicles and all these other things that were supposed to grow enough to offset our demand for oil. And meanwhile, Saudi Arabia is investing in new sources of supply to grow its capacity so that it can supply into a world that it knows is going to demand more oil. And nobody has better insight into what global supply and demand is like than a company like Saudi Aramco in Saudi Arabia. They're a large supplier, a large exporter. They have contacts in China. They know what China needs. They have a very good sort of 30,000-foot view of the oil industry. They know what supply and demand are like. And they're investing because they know that supply and demand balance looks very tight over the next few years. And unfortunately, there's absolutely nothing that we can do here, right? Or that the Fed can do, or that the US government can do, or any European government can do to change that near term, because it takes time to find and develop new sources of oil and gas, bring those sources into production, and actually have it influence global supply. And until that happens, I think we're in for, broadly speaking, there'll be dips along the way, no doubt. But broadly speaking, we're looking at a higher for longer global environment for oil prices, for natural gas prices, and for many other commodities as well. Uranium on the energy side is another one I'm interested in. But really, there are a lot of commodities facing a similar chronic undersupply, chronic tightness in supply-demand balance.
Well, lack of investment, yeah, too. And especially with the Fed raising interest rates at these levels, we were talking before we started recording, if you're a SEC accredited investor and you have, $5 million, $10 million, $20 million, you want to park your your savings now into U.S. Treasuries, 30-day U.S. Treasuries at a quote-unquote risk-free 5%. And a lot of people are doing that, whether it's a hedge fund or retail investors. They're not funding these projects. We're seeing this with a lot of the private shale well companies. They're not getting the capital. Those companies, the last 12 months, they've been selling out a lot of their assets to a lot of the publicly traded independent shale oil producers But looking at the global supply demand, I mean, the oil inventories, the global oil inventory. So people focus on the US oil inventory numbers, but the global oil inventory numbers are down a lot. That's why the US is exporting. The US is exporting a lot of stuff to meet the demand globally because there's a higher price globally. It's not because there's an oversupply here in the US. Also, the supply numbers, Elliott, too, they're not all oil. So everyone's like, oh, even though the rig count's down over 20% since the November 2022 highs, I always hear the oil bears say that, well, the US is producing a lot more oil. They're not talking about how, like, in that oil mix or the energy mix, they're counting like natural gas and natural gas liquids, because a lot of those Permian wells are not mostly oil, are they?
No, most wells in the Permian, as well as really anywhere in the United States, contain a mixture of hydrocarbons. For example, in the Permian, you're probably going to have, when you produce a well there, you're probably going to have a mixture of natural gas liquids like propane, ethane, butane, natural gasoline, and of course, crude oil. And all of those are important. And in fact, I think about a year ago in November 2022, the Energy Information Administration, which publishes those weekly supply numbers, they actually came out and said, we realize there's something wrong with the data, because we keep having these huge adjustment factors, which are much bigger than anything we've seen historically. In fact, last week we actually had the largest one ever. And one of the reasons they identified for that is that, for example, some of the quote unquote oil that's being exported is actually not just pure oil. It's some other mixture of hydrocarbons that's being exported. And so the volumes don't necessarily add up. So it's definitely an issue. But frankly, I see a lot of interesting things going on across all those hydrocarbons, right? So we've got oil, and yeah, you're right. The U.S. exporting oil for a number of reasons, partly due to the type of oil that we produce in the United States, which is primarily light sweet crude, which is in very high demand abroad, but we're also exporting more ethane. In fact, we're one of only 2 countries in the world that can actually export ethane. The other one is Norway, and we're by far the larger exporter. And ethane, nobody knows about it or really cares about it, right? Usually, nobody talks about it on financial television, for example. But it's a hydrocarbon used to produce ethylene, which is a base chemical for most plastics, everything from consumables to the PVC pipe in your home, right? Kind of important. China is actually has built and is building a ton of capacity to create ethylene from ethane, but they don't have a lot of ethane supply. So they're actually importing it from the United States. Propane is another one. When you think of propane, you probably think of your grill sitting on the back deck, or maybe propane heat. But the reality is that we're a huge exporter. We're a large exporter of propane, the largest in the world. And, it is used as a petrochemical. And these are all natural gas liquids. It's used as a petrochemical to produce polyethylene. It's also and India is a major importer of it. And they're using it as a cooking fuel, because a lot of places in rural India, most people still use wood, and it's causing actual real particulate matter pollution, right? And so they're starting to convert to propane, which is much cleaner burning. So the US is a major player in all these markets. You're right, these volumes don't add up, but we are actually exporting everything from natural gas to propane to ethane to crude oil to various places around the world.
So that U.S. Department of Energy, the Energy Information Administration, that number that's saying that total oil production in the U.S. is still going up like crazy, or it's up a lot, that number is very misleading then, because it's including all these other types of natural gas liquids that you just described. Then it's not just pure oil then.
It could be, and just the number itself is based, again, all these numbers are based on surveys. So you're basically asking companies to provide data for you. And so we don't really know how accurate it is on a month to month or week to week basis. In fact, I mean, one thing they did a few years ago with the petroleum production, the crude oil production figures, is they used to provide sort of an exact number, and now they round up or down to the nearest 100,000 barrels because they realized that providing an exact number was making it look like they actually knew how much oil was being produced in the United States on any given week, which is pretty much impossible given how many wells there are around the United States. And yeah, you're right. I mean, we don't know exactly the mix of hydrocarbons in crude oil supply that's being produced, whether some of the natural gas liquids are being left in the crude oil supply or separated.
Well, we know the rig count, though, and the public comments from, I think, the CEO and the senior executives at the larger Permian drillers like Pioneer Natural Resources and Sandridge, they've said that over 30%, I think in some cases it's over 50% of the energy coming out of each well they drill is not pure oil.
That's right. Usually it depends upon the producer, but just because a producer is considered to be an oil producer or a natural gas producer doesn't mean that that's all they produce. For example, Range Resources is considered to be a natural gas producer that operates in the Marcellus Shale. About a third of their production is actually propane, ethane, butane, and other natural gas liquids. You mentioned Pioneer, and they are in an oily part of the Permian. But if you go out to the western portion of the Permian, which is called the Delaware Basin, look at a producer like Devon. Devon, a lot of their wells have less crude oil than natural gas liquids and gas, even though Devon is mainly widely considered to be primarily an oil producer. They have in the Delaware Basin in the western U.S. There's a ton of those wells are much gassier than in the Midland part of the Permian, which is further to the east.
Oh, I consider Devon more of a natural gas producer, but I think they've been doing acquisitions the last 3 to 5 years to try to get around 50-50 oil and natural gas. But I personally consider them more of a natural gas producer.
Historically, they were. The last sort of 5 to 7 years they've spent, or even longer than that, I guess, they've spent they've grown their oil production and they've kind of focused there on the liquids portion of the business. They do actually have some interesting gas plays out in West Texas as well. But really, that's another reason behind the Exxon Pioneer merger, right? Exxon has acreage. So the Permian Basin, there really are, from a shale perspective, there's two halves, right? So you have the Midland Basin to the east, which is all in Texas. And then you have the Delaware Basin to the west, which is partly in Texas and partly in New Mexico. The Midland Basin is where Pioneer is basically a pure play on the Midland Basin. And then the Delaware Basin, Exxon had most of its acreage there. They did have considerable acreage in the Midland as well, but most of it was in that Delaware Basin. By acquiring Pioneer, not only do they have the largest acreage of any player in the Permian, but they've also got a better mix of both halves of it. And that's advantageous because, as I said, those Midland Basin wells are a lot oilier and you get less other stuff in there. Whereas the Delaware Basin, you're going to have more of a mix of hydrocarbons. So I think that's a major motivation behind it as well. They wanted to have a strong footprint. I would argue the best footprint in the Midland Basin portion of the Permian. But you're right about on the production issue. If you look at the major producers out there, Pioneer, even Chevron, Exxon, et cetera, their growth rates in terms of production from that play were very modest in comparison to what would have been normal, in the boom years back before 2014, where, Pioneer, for most of its history, I mean, they were one of the largest independent players in the area for most of the history of the Permian. You can look at a chart of Pioneer's production and pretty much match it up with total Permian production in the sense that they were, it's a little bit of a cliche, but Pioneer was actually a pioneer in the Permian, right? And a pioneer of shale. For most of their history, they outspent their cash flow, right? They spent more money on drilling and bringing wells into production than they actually generated in cash flow from those wells, even when oil prices were high, not just after 2014, but even when oil prices were high, they were outspending their cash flow, and they were focused on production growth. And it's not till 2019 that they started focusing on free cash flow, so profitable production. And since then, they have acted more like a major than a traditional wildcat or independent. They've been very much focused on slow rate of production growth and generating free cash flow. And I think there's a misconception out there that there's still a shale boom around the corner. That there's going to be a ton of excess production from the United States and oversupply that's going to send oil prices down. And people are, kind of like a Pavlovian response after all those years of, the shale boom years. But if you look at what these companies who are the major producers in the Permian are doing, they're talking at best 5% on the oil side alone, excluding their gas and natural gas liquids. They're looking at, at best 5% annualized growth. I mean, that was Pioneer's, the high end of Pioneer's guidance on the oil side for when prices were really strong. Mostly they're trying to hold production constant at times like this, cut their spending, cut their CapEx, and generate more free cash flow. And I think that's why you're seeing what you're seeing, right, with this consolidation, where you're seeing Exxon buy Pioneer, companies like Chevron buying up acreage over the last several years, buying up companies like PDC Energy, which had some acreage there in the Delaware Basin. And the reason is that the Permian Basin is an amazing oil field. It may be the most impressive single oil field anywhere in the world. It's huge. It's almost 50% of U.S. oil supply, just the Permian Shale. But it's still limited. There's only every oil field in the world, the biggest oil fields in the world, all eventually sort of peak or reach their growth, their inevitable sort of plateau of production. And that's what you're seeing in shale now. Pioneer, Exxon, Chevron, they all have a limited number of drilling locations. And when you're producing from shale, you have to drill a certain number of wells just to maintain your existing output, because the decline rate from older wells is so high. And then if you want to grow, you have to drill even more aggressively. And they know there's a delicate balancing act there. If they try to grow production 10, 15, 20% a year like they did during the boom years, they're going to run out of drilling locations very quickly.
Well, the other factor now is higher interest rates, higher cost of capital. So you correctly mentioned, and this is for all natural resource companies, whether it's an oil, natural gas producer or a miner, it's the depletion. So you have to replace those reserves and the production that you produce. You eventually have to replace it due to depletion. Other industries don't have to worry about that. So then you have the CapEx issue. As you pointed out, these wells are going to be higher costs. They're not drilling the easy tier one stuff. Yeah, the octopus drilling pads are a lot better, a lot more efficient. There's a book out called The Frackers about this, talking about this, but they're just pulling the oil out of the ground faster with their production rates years ago. So that means then that so they grew production with the octopus drilling pads. They put more straws in the ground. They pulled the production out faster. It's tougher to replace it longer term. But now the other factor is higher interest rates, higher cost of capital. That's going to mean even less supply now too.
Yeah, and I would say that you're absolutely right. Back in the boom years, I remember, sitting in an energy conference and listening to companies present how they were showing amazing, and big companies I'm talking about, names like Pioneer, and they were showing amazing productivity gains from doing things like changing their fracturing design or putting more proppant, which is sand, into the wells to increase their productivity. And so there were a lot of things in the early boom years that they were doing to massively increase the amount of oil they could generate from each well, and also cutting the cost of drilling. Those easy efficiency gains, those simple sort of changes to well design that caused these huge productivity gains back in, say, 2010 through 2014, 2015, even up to 2017 or so. That's done. Yes, they're all working on ways to cut costs. It's all about bringing costs out, increasing your efficiency. But the quantum leap type of gains in efficiency that we saw 10 years ago, that's not happening. Really, it's about good well locations, right, on prime acreage, and drilling wells that fit a model that in other words, drilling sort of whatever your standard well design is on that acreage. Trying to get contiguous acreage so you can drill longer horizontal wells. And yeah, I mean, that's exactly why, again, I mean, like you said, the cost of capital is an issue. And, who has easy access to cheap capital, right? Exxon, Chevron, names like that, the big guys. And
Saudi
so they're the
Aramco,
ones, yeah, they're the ones who can finance this thing. And they're the ones who can, it doesn't really matter to them so much. They're generating so much free cash flow. It doesn't really matter to them as much where interest rates are, because they don't have, they don't have the kind of debt load that, a smaller producer or an independent or a private producer would have. So for them, it's less of an issue. And, they can go out there, they can buy acreage that fits well with their acreage. They can drill more of these longer lateral wells. And, they have economies of scale on other things. For example, when you drill a well in, say, the Permian or anywhere, and you're fracturing a well, it requires a lot of water. And so a major expense that companies like Pioneer and Exxon have made is to build these water recycling plants that can take used water from the fracturing process and recycle it. And they can save money doing this. They can save money in terms of not having to pay as much for a new supply of water, but also not having to pay as much to dispose of water that they can no longer use. And it takes a lot of capital up front to build one of these plants. And Exxon and Pioneer have them. And so they're buying all this infrastructure related to that, to the fields as well. They're buying the water recycling plants. They're buying the gathering lines and some of the smaller pipelines for transporting water, for example, along with Pioneer. And that's a major thing, and it makes it very difficult for a small producer to survive or thrive. And that's why you're seeing a lot of this consolidation. I mean, it's a lot of different factors, but it's going to continue. And I can tell you that historically, when the majors start buying something like this, it's because a major company like Exxon or Chevron, when they produce a field, in other words, it has to be a big field, because otherwise it's not going to move the needle for them. I mean, Exxon produces, so much oil that, adding a field that generates 100,000 barrels a day, it doesn't matter. So they're buying these. What they want is they want to develop these assets like the Permian Basin to produce, 1.2 million barrels of oil a day, whatever it may be, and then be able to hold that plateau of production for a long period of time. So because Exxon's buying Pioneer probably means that you're going to actually have less aggregate production growth from the Permian than if those two were operating alone. Because, Exxon is just looking to have a runway, an inventory of drilling locations that they can exploit over the next 20 years to maintain their production at some high plateau level. They're not looking to grow oil production from the Permian at 20% annualized. They're looking to, have a long period.
Can anyone even still do that? Grow 20% annualized?
Only if you're maybe if you're a really low base of production and you're drilling very aggressively, you could, I suppose.
So like a small cap. So like one of those tiny little Permian producers then?
Perhaps. I mean, I've seen some stronger production. I mean, for example, like Matador Resources is a small company, a small producer, publicly traded, that produces in the Delaware Basin side of the Permian. And they're growing production relatively rapidly, partly because they just made an acquisition of a private company. But they're the exception rather than the rule. And I suspect that longer term they're looking to get acquired too, right? And because they know that it's unsustainable for them to fund that kind of growth for more than fairly short period of time. So I think that the supply side of the equation, the idea that there's going to be this with $70 or $80 oil prices, there's going to be this surge in U.S. oil production that's going to overwhelm the global market. It's pure fantasy.
Yeah.
U.S. production can grow, but it's going to be at a much more measured pace than what we saw in the boom years. It's a maturing asset.
Yeah, I actually was going to ask you what sources of new supply are available with oil at the current prices. So when I look at OPEC and the Saudis, Russia, I mean, they just announced a couple of days ago they want to maintain the supply cuts. Now, I think CapEx spending was up 40% year over year, but we have to look at that in perspective. That's just to actually maintain current production levels. It's not massive growth. In a lot of cases with the OPEC plus producers, they're actually not even hitting their production quotas. A lot of the OPEC plus producers, the production numbers are still falling. And then there's projections that one of the oil industry research companies that surveys a lot of the oil companies extensively, they're saying that $5 trillion of capex needs to be spent by 2030 just to maintain the current oil production levels. But it looks like capex, Elliott, besides that 40% increase the last 12 months, the capex is going to be trending down now, except for maybe a few areas like deep water offshore Guyana. But other than that, I don't see big capex bills being spent by a lot of the players in the industry.
No, it's not. It's absolutely not. And in fact, that's something that I think is going to prolong and elongate this cycle. Historically, I mean, the energy business is one of the most deeply cyclical businesses there is. So when prices go up, it discourages demand. It encourages people to go out and explore to produce more of oil or gas, right? And when prices go down, the opposite. So you have shrinking supply and better demand. In this cycle, we've seen, especially since 2021 or so, we've seen a surge in oil prices, but we've seen very little or no demand response. I was looking the other day. I look at about 40 companies that Bloomberg tracks in terms of, and these are big companies like Exxon and Chevron, as well as small independents. And, in the boom years, at the peak of the boom, 2013, 2014, these 40 companies, some of them been acquired. So I'm still counting the production. It's just part of a bigger company now. They were producing sort of $450 billion a year in capex, in total capex. At the lows, right, when prices collapsed after 2014, it got down under 250 billion. So basically halved. It's barely budged since. So, there's not any spending out there on the part of these big oil companies around the world in terms of going out and producing more oil and gas. They're spending some capex on other things, like alternative energy and whatnot, but they're not spending. There aren't those big new accumulations of oil and gas out there that can come in and meet the world's demand for energy, cost effectively, which is why you're seeing this floor at a relatively high level for oil and natural gas prices globally. And I think that's going to continue. And, you look at it, the plans based on company guidance is not for a lot of spending in 2024 either. So even when oil prices got up over $100 a barrel last year, there wasn't a lot of talk of accelerating capital spending. Companies are just maintaining their spending. They're not out there doing aggressive acquisition or
they were focused on benefiting shareholders, right? So they were paying down debt on the balance sheet. They had free cash flow, so they were growing dividends, share buybacks if their stock was cheap, maybe an acquisition here or there, and paying down debt. So like Exxon Mobil, who borrowed a bunch of debt in 2020, and a lot of people were criticizing them for it. That was a counter-cyclical move. They took on a bunch of debt in the balance sheet. The oil price went up. They had a bunch of free cash flow. They paid off most of the debt. Now they have all this future oil production.
Right. And, Exxon, one reason I really like the stock, and it's my favorite of the super majors, is that they're the only one who acted like a super major is supposed to. In my opinion, what's the point of being a massive oil company like Exxon, where you have, your market capitalization is way larger than the GDP of some of the countries you're operating in? It's because you have easy access to capital, relatively cheap, easy access to capital. And as a result, you can spend in the down cycles, as you said, counter-cyclically. And historically, that's what the majors have done. When oil prices are down, they go out and they can hire people. Labor costs are down. The cost of doing all that services work is down. They can cut deals with local governments to get, access to resource.
Cheaper royalties too, cheaper land, cheaper royalties. The governments are like, they're like, okay, we'll give you the land now for cheap and royalty, and then if you have a discovery or the oil price goes up, then we'll raise the royalty.
Well, yeah, I mean, you have that in places, but where they've invested, Guyana particularly, it's probably I think we talked offline before as well. I think it's the biggest oil discovery, the most important oil discovery, anywhere in the world in the last 20 years. It's one thing about it is it's a deep water play. The government there knows that the only companies in the world they can afford and competently produce the thing are a couple of super majors, right? Probably Exxon and Chevron, who are soon to be partners on that deal, are probably two of the most likely, or two of the only ones that can do it. And so, they can't really afford to annoy those companies too much, because they're kind of killing the goose that laid the golden egg. But again, I mean, Guyana is a field that if it weren't for Exxon, we probably wouldn't even know about it. In 2015. First of all, back in 2008, 2009, Exxon started doing 3D seismic work offshore deepwater Guyana, and they really hadn't found much shallow water or onshore. And so they identified a few prospects for test drilling. And in 2015, they went to their joint venture partner, Shell, which is obviously a big company as well, and said, hey, Rex Tillerson, CEO of Exxon, said, do you want to participate in an exploration well we want to drill on the block here, the Stabroek block here in Guyana? And Shell said no, they declined. And it was only because Rex Tillerson knew the Hess family personally. He was able to call Hess, and they agreed to come in with the 30% share. And that's how they drilled the Liza-1 well, which was a discovery well for this massive find. And Exxon spent billions of dollars, right? Tens of billions of dollars every single year developing this thing before they generated the first commercial drop of oil in 2019. And Hess did too. And if as you said, they received nothing but criticism for it. Hess did too. You had that engine number one activist hedge fund that was trying to say, they should stop all this exploration work in places like Guyana, focus on, free cash flow, and then also developing their alternative energy investments. You had people saying, oh, they're borrowing too much money, they're going to have to cut their dividend. All this criticism, and in the end, that's exactly, in my mind, what a super major should do. They should, when prices are down, they should be investing capital to find the next, Guyana or Guyana, and be able to grow their production during the next upcycle. And unfortunately, Exxon is really the only company out there, the only super major out there who did that on the oil side. All your European producers were talking about alternative energy. They were talking about allowing their production of oil to decline naturally because demand wasn't going to be there for it. And so therefore their production is declining. And now in many cases, for example, Shell, BP, even more so, they're now having to reverse course and try to, scrabble together some production to keep their decline rates from being too big. And they're behind the eight ball. And again, I don't see, as we just discussed, I don't see another Guyana out there anywhere in the world.
Also, you have the older fields. Let me add your points there. You have the older fields like Cantarell in Mexico. So Mexico's now, I don't think they're a net exporter of oil anymore because they subsidize so much cheap energy demand in their own country with cheaper gasoline, artificially cheap gasoline. So Cantarell field, that's petered out. That's depleted enormously. And then the Saudis with Aramco and Ghawar is massively depleted, but the Saudis are replacing those $10, $20, $30 barrel oil fields at Guyana. They're replacing it with deep water offshore fields that are what, $40, $50, $60 a barrel.
Right. Saudi Arabia, which, as I like to say, has probably the best view of the global oil market of any company. They're now publicly traded, as you know, the last several years. They're spending more money than they ever have, at least since we have numbers for it, on capital spending, this year than they ever have in the past. And, the reason they're doing that is, as you mentioned, they know that global demand for oil in a normal economic environment is going to be too much to be met by current global supply. And Saudi Arabia wants to add to their capacity to produce oil because it gives them control over oil prices. Saudi Arabia is still, even so many years later, they're the only country, Saudi Aramco being the only company, who has proven their ability to, quickly ramp up or down their production by, millions of barrels a day. And, that gives them an awful lot of power, and they want to maintain that power by having that capacity. And meanwhile, a lot of Western countries and Western companies, frankly, are kind of twiddling their thumbs and saying, well, maybe oil demand is going to peak in the next 5 years. I mean, how many times have I heard in the last 10 years that oil demand is going to peak in the next 5 years? And it never has.
Well, I
it's
think
hitting another record this year.
I think it's like the ESG bureaucrats at these like Davos type agencies, and they're trying to speak it, but the data says the opposite. So if
That's
you're
correct.
in India, you're in Latin America, South America, you're in Africa, Asia, the Middle East. I mean, all people have to do is compare pictures of some of these cities from 10, 20 years ago. There were people on bicycles or walking around. Now they have motorcycles, electric scooters, small cars, small SUVs. That's a lot more energy consumption than it was even 10 or 20 years ago. And that trend's not going away. So yeah, Chinese demand may not be as high as people expected, but all these other countries in the emerging markets, I mean, people are switching from normal bicycles or walking. They're switching to consuming mass amounts of energy at like scooters and motorcycles and small cars.
Oh, absolutely. And I think what a lot of people don't realize is that, in 2010, right, the big three hydrocarbons, by which I mean oil, gas, and coal, accounted for about 86.5% of global energy consumption, right? Last year, 2022, the same three fuels accounted for 81.8% of global energy consumption. So I think there's a misconception out there that that these alternative energy technologies, for example, are displacing the need for oil or gas or coal, and it's just not true.
Well, it's economics, right? So if you're in a country in Latin America, you can't afford an $80,000 luxury electric vehicle. You also don't have the infrastructure of the charging stations, but you can afford to buy a used scooter or motorcycle. So it may or take the bus.
And even look at your developed countries. I mean, remember a few years ago when Ford said they were going to produce this F-150, which is the most popular passenger vehicle in America. It's a pickup truck, Ford F-Series F-150 pickup truck, and they were going to produce an EV version called the Lightning. You may have even seen a couple around the road. And that was going to, and a lot of the brokers were out saying, oh, this is going to be huge. There's going to be some more units of this car than any other car, in the United States pretty soon. Everybody's going to want one of these. Well, Ford in their most recent conference call revealed that, they're losing $26,000 for every electric vehicle they produce. And, GM and Ford are now moving capital back from EVs to traditional, ICE cars, internal combustion engine cars. And
well, the big automakers only make profits from their sport utility vehicles and pickup trucks. Those are the largest profit margins. I was watching the interviews with the United Auto Workers. They said if they switch to electric vehicles, they said they're not needed. they said that electric vehicles, you don't need as many humans to put all the parts together.
Right, and you probably wouldn't be selling enough cars to make it worthwhile, right? So I think people make the mistake of thinking that a lot of these transitions are going to happen a lot faster than the reality is. I mean, I don't think you're going to see global oil demand peak until the 2050s or 2060s at best.
Definitely not. I mean, switching to electric vehicles and a lot of ESG, if you're in a developing country and you start off really poor, you can't afford to go buy electric vehicle. You also don't have the infrastructure. So it makes no sense. But it's like this Davos crowd people, the billionaires saying they need to do this. Meanwhile, a lot of the other countries, I mean, the gasoline consumption, the diesel consumption, the electricity consumption,
Right.
they're all up. They're all trending up. Now, China hasn't come back as much as expected, but a lot of these other countries, I mean, people are going to decide if they have a job and savings, they're going to say, I don't want to walk to work, or I don't want to take a bus for 3 hours each way. I'm going to buy a motorcycle or an electric scooter or a small little car.
Right. And that's going to continue. And they also can't afford to pay, 40 cents a kilowatt hours for electricity like the Germans do. And honestly, the Germany can't afford it either, because they're going to be in their probably their third recession in the last 3 years by the end of this year. I think there's a misconception out there that this is a dying industry, that fossil fuels are dying, demand is peaking, but the reality is, we've just discussed, is far different. Whether you want to look at emerging markets and people who for the first time in history are buying cars, or traveling to work on a bus powered by diesel, whatever it may be, demand is not going to go down.
It's just stupid or corrupt or brainwashed politicians. You have the governor of California saying they want to phase out all internal combustion engine cars by 2030, but do they even have the infrastructure for all the electric charging stations to do that? It's just ridiculous.
No, I mean, it won't happen. And, you've seen countries like the United Kingdom, for example, push back these targets because they realize it's not workable. But I would say that, as much as I hate all of this, right, this idea that that we can end oil, you've heard this group, just stop oil, is being ridiculous. And I think it's really bad for...
Look, they have private jets and yachts, though. I mean, these are some of the worst hypocrites. I mean, some of them are...
it's absolutely. And, but this whole idea is very negative for the economy and for the country, right? Whether it's the UK or the US. But, it's very bullish for oil prices, because the more of this that goes on, and the less investment there is. And the less investment there is, the higher oil prices are going to go, and the longer they're going to stay there. And again, I mean, it all goes back to the inflation issue. In the 70s, a lot of people say, okay, well, it was Paul Volcker who came in and jacked up interest rates that caused inflation to come down. I mean, that was probably part of it, but I think the bigger thing, especially on the commodity side, was finally bringing supply online. The Mexican supply, the North Sea supply, the North Slope of Alaska. And that non-OPEC production growth is what dented OPEC's control of the market. I don't see where that non-OPEC production growth is going to come from. I see more, OPEC spending, the Western world not spending. The few companies that are haves, that have access to good resource, are going to do well. The companies that can enable it are going to do well, but it's going to take a multi-year investment cycle before we get to a point, where we're going to have those new sources of supply that can come online. The idea that shale alone can do it this time, I mean, it's a pipe dream.
Well, shale was the only source of production growth from 2009 to 2019. So that was the only percentage gainer for global oil production growth. I mean, OPEC wasn't investing a lot. There wasn't a lot of Deepwater was in a bear market. I mean, like, there was a ton of bankruptcies for the deepwater offshore drilling companies. I think Transocean almost went bankrupt. Diamond Offshore sold out.
Seadrill went bankrupt. Yeah.
Seadrill went bankrupt more than once. I think Seadrill was restructured 2 or 3 times. I had some of these bankruptcy restructuring experts. I mean, I don't know why they need to be restructured that many times.
Right. Yeah. I mean, it's absolutely true. I mean, and you said, as you said, the shale dominance, right? So, since from 2009 to 2022, if we look at cumulative global oil demand growth over that time, it was somewhere between 13 and 14 million barrels a day between 2009 and 2022. And over that same time period, the cumulative growth in US oil production, which is primarily shale, right, was something like 10, 11, million barrels a day. So over that time period, right, I mean, shale enabled 80% plus of global oil demand growth. And that's not going to happen this time. It's not going to happen this time because we can't grow our production to the same degree that we did before, because the fields that enabled this, like the Permian, are mature. And that's why you're seeing, this consolidation.
And those shale wells, a lot of them deplete very rapidly in the first 1, 2, 3 years, even if they're tier 1 acreage. But then you also have the large super major fields like Cantorell and others. Those are in permanent depletion. There's very little ways to start regrowth of production of that. So, and in Venezuelan oil production is not trending back up. It was 4 million barrels per day, I think, in 2007. It's nowhere near those levels. So there's just I was speaking with oil hedge fund manager Josh Young about this. And yet he's very, very bullish on deepwater offshore Guyana. But he said relative, if you look at the global oil production base, I mean, a lot of those super major fields, deepwater offshore Guyana is great for Exxon Mobil and now Chevron that bought Hess. But for the global oil production, I mean, it's not going to offset the depletion at any of those other super major fields that are in permanent depletion. That's what he said.
No, I mean, that's absolutely, I mean, a lot of people look at consolidation and say, oh, well, now, Exxon's going to go in there and produce all this oil. But it's not like there's more oil in aggregate. It's good news for Exxon. I think it's good news for Chevron to buy Hess. It's going to help them. It's going to help their growth, but it's not actually changing global demand growth.
Well, the supply, you mean it's not fixing the supply problems that we're seeing.
No. In fact, I think what's more likely to happen with a lot of these consolidations is you're going to have the smaller, faster growing producers who are more aggressive, right, and more growth oriented. They're going to get acquired by the bigger, stable, low cost of capital, slow and steady free cash flow producers. And what do you think happens when that happens, right? Obviously, you get slower aggregate production growth because the big company just wants to generate free cash flow. And it's happening on the gas side as well. I think, and there's been rumors to this effect, and I think it's likely that, ultimately, Chesapeake Energy will acquire Southwestern Energy. And they're two gas producers that have assets that fit very well together. But again, it's all about grabbing as much acreage in the key plays that you want to have. It's about economies of scale, lowering your costs. It's not about production growth. It's not about growing your production more than you would as two separate companies. It's literally about, producing a certain amount of gas, in this case, more profitably.
So in this environment, because potentially there's a recession in the short term, potentially some demand could come offline, not necessarily a lot of demand, but maybe temporarily there is. What are the best companies, and in your opinion, for oil prices in a trading range or short-term lower or a sideways or volatile oil market that's in a trading range, say from like $60 a barrel up to $90 a barrel?
Well, I think it's on the oil side, I think it's hard to go wrong with a major like Exxon. I know that's not the most exciting pick, but this company is a company that is built a huge base of relatively low cost production. They're selling off a lot of their higher cost production, reinvesting that capital to develop things like Guyana. Most of their Guyana wells, they say, would be profitable even with Brent at $25 or $30 a barrel. Exxon's been hit short term, partly because of their acquisition of Pioneer, and the market, is punishing companies that are acquirers. But I think Exxon, near current levels around 100 or a little over 100 is a great deal, because longer term, they're one of the only haves, one of the only big companies out there in the world that actually has a reserve that can, grow production significantly to take advantage of a strengthening market. I think that the other area that's very interesting from an oil perspective is to look at some of the bigger services names, because as I said, we're going to have to see ultimately more spending on exploration and development, more production to actually truly bring about a decline in commodity price inflation and bring oil prices down. So I think a company like SLB, which was for most of my career has been known as Schlumberger, they're a big services company. They have a lot of exposure outside the United States. They work in all the Middle Eastern countries, like Saudi, that are spending more. They obviously work in places like Guyana. as well. I think that's going to be that type of company is going to be a major winner of all this. You could look at some of the smaller services companies that are focused in areas like deep water, because I think that's going to be, a lot more. I think you're going to see, let's face it, a lot of the world's big remaining oil reserves are in what we call, not easy oil. It's oil that requires drilling in deep waters, in harsh environments, in the Arctic, right? For example. So you could look at
Guyana or Suriname, which is the two main plays, a lot of investments going in there, or deepwater Brazil or Africa,
yes.
off the coast of Africa. So those are the major plays, and the deepwater companies are booking the rigs for those.
The deepwater companies are booking the rigs for those, but also I look at a company like Technip FMC. Excuse me, they produce a lot of the subsea equipment. So, when you produce a deepwater well, you don't have all your equipment on the surface of the ocean. It's on the seafloor. So pipelines, you have
blowout preventers, yeah.
Yeah, blowout, Christmas trees, which are basically valves and pipes that on onshore well or land-based well, they're pretty simple. It just looks like a Christmas tree. It kind of has that shape. Obviously, it's a lot more complex and expensive in deep water. You're dealing with very high pressure reservoirs, so they make a lot of that. I think the stocks run up quite a lot. I'd probably wait for something of a pullback, but I think from a long-term perspective, a company like that could do very well on the oil side. And I actually think, that right now on the smaller shale producer side, I think the better deals are in the gas side. And mainly because gas prices right now are still relatively low. I know I was on your show back in maybe February or March. We talked a lot about gas, and prices were even lower then. But, you look out towards the end of next year, the futures are showing, gas prices around $4. And a lot of that's because of all this new LNG export capacity we have. So I think there's a lot, and there's plenty of demand for U.S. gas exports to replace, Russian, imports into places like Europe. So I think there's a lot of opportunity on the gas producer side right now. That's probably the best value in energy. But the oil side, it's a multi-year secular bull market.
And then I want to ask you, because I didn't get a chance. I know we were talking about this before we started recording. What is your opinion then of why Chevron bought Hess Oil? Because I was under the impression, I interviewed Christine Guerrero about 6 months ago about the deepwater plays in Guyana and Suriname, and she said that Chevron was buying acreage, but it sounds like they were really behind the curve behind Exxon Mobil and Hess Oil.
Yeah, the Chevron deal to acquire Hess is very much like the Exxon deal to acquire Pioneer. It's all about access to resource. And, Chevron realizes that Guyana is one of the only large non-OPEC oil finds in the last 20 years of size, move the needle size. And I believe you're right. They did buy some exploration rights to various acreage, but the Stabroek block, which is where all these oil finds have been, I think they're up to like 30 some separate oil discoveries that they've announced.
Wow.
Yeah, that is actually 45% owned by Exxon, and that's the operator. Hess has 30%, so that's what Chevron would be acquiring. And the last 25% is China National Offshore Oil Company, which is a Chinese, as the name implies, company. So Hess had 30%, which is very unusual for an independent company like Hess's size to have that kind of a stake in a major offshore development like that. It was difficult for Hess to come up with the money to fund all the capital spending, because remember, with a conventional oil project, for years, you're just shelling out, just writing checks for building out the infrastructure, for the exploration work, and you don't see a drop of oil. So it's very capital intensive up front. And then you get this long tail of plateau production at a high rate that generates copious free cash flow, even at $25 or $30 Brent for years and potentially decades. But obviously Chevron wanted access to this spectacular resource. And honestly, Chevron and Exxon has got to be kind of the dream team as far as developing a project of this complexity. As we've talked about, it's not a simple matter when you're drilling in water that's 8,000 feet deep, right? You're dealing with extremely high pressures, temperature issues, all kinds of stuff. Building out this infrastructure, only a few companies in the world can do it. And then you have to have the help also of companies like, SLB or Schlumberger. So, I think they're buying it clearly to gain access to this resource. And if you think about it, with this deal, Chevron is becoming kind of like a slightly smaller version of Exxon, right? Because they're already a major producer in the Permian, which is one of Exxon's focus areas too. And now they're going to be, a large junior partner to Exxon in Guyana. And so their two assets for those two companies are going to be, pretty much the same two main assets.
Well, those sounds like the only growth assets, though, in the Permian Basin, the certain areas like the Delaware Basin, like you said, and then also deepwater offshore Guyana. Those sound like the two main sources of growth. So it would make sense that both companies would go invest there. Chevron was behind the curve. Sounds like a lot behind the curve. But all these exploration drilling wells, the more exploration wells they drill, they're finding new pools of oil reservoirs deeper and deeper they drill. So potentially there could be many billions of barrels more of oil reserves to find the deeper they drill there in offshore Guyana.
Well, and a lot of the projects they brought online the first phase, Liza, back in 2019. There's been a second phase of Liza since then, and then there's another one that's coming online this quarter, another play. And each of these plays, they've actually ended up producing more oil than they said they would be able to. So they're actually outperforming expectations. So, and I think that'll probably continue. And they've announced significant growth in production out to 2027. But beyond that, there will be more, because even if just developing the plays they've found so far in this one block, they've got years of development beyond anything they've announced. It's just that, obviously they make a final investment decision on a project, and then they move forward with that, and they start making final investment decisions on additional projects. But it takes time to sort of cycle through all these opportunities from established discoveries. So, it's one of the only assets that's going to grow actual oil production, anywhere in the world. To be fair to Chevron, they do have an outstanding global natural gas.
They've done some very smart they've done some really smart natural gas acquisition deals the last 3 to 5 years. So they've been prudently investing on the natural gas side, but they're really far behind on the oil for deepwater offshore Guyana.
And that's right. That's exactly. I would say Chevron is another name I think is very good name. I think I like them as well. But you look at those two, say vis-a-vis some of the big European majors, which have historically been equivalent, right? BP, Shell, even Total Energies, or on the smaller side, a name like Eni in Italy. And mostly, especially BP and Shell, they really misstepped in my view. They cut, BP was going to have their production drop, was it 25 or 30% between 2020 and 2030. And they've now had to go back on that. They've got a new CEO coming in. The last CEO had some sort of inappropriate relationship, right? Which may or may not be real. I don't know. Maybe they just want to get rid of him. Right?
I'm not familiar with that. The last time I looked at BP, their costs of their wells were way higher than relative to the other oil and natural gas super majors. They had massive losses on their Russian oil investments, and then they allocated just way too much. I think it was political pressure from pension funds, politicians, and bureaucrats in the United Kingdom. They allocated way too much to ESG and wind, solar, biofuels, and those were all in billions of dollars in losses.
They're losing money. They're losing money in it, and they can't cover. And so they've now replaced the CEO, and they've the architect of that policy has been basically disposed of. The incoming CEO, the incoming management team have said they're going to divert more capital back in favor of oil and gas. There has been some political blowback to that, but for them, it's really at this point a matter of
But if they can't make money, they can't pay the dividend for the pension
Right.
funds, and then they can't pay the taxes to the governments for the royalties. So, I mean, like they're fighting them. You have to allocate to this, but then if they're losing money, then they can't pay the dividends to shareholders and the taxes to the government.
Right. And I think the most positive thing that's happening to those European companies is that, for a long time there, oil prices were relatively low. Gas prices were relatively low. Everybody was able to import gas relatively cheaply from, say, Russia. And that sort of cozy environment was interrupted, overnight, right? And now a lot of these countries are refocusing on energy security, not just, climate change or emissions reductions, but now energy security has risen to the forefront. And so a lot of countries and companies are talking about developing fields, which just a few years ago, they would have told you would never be developed. It's funny how, a change in the economic environment can have a massive impact on these, previously published
also
government
Middle East,
targets.
not just commodity prices going up and importing higher cost energy, but also like if there's Middle East tension, I mean, conceivably, let's hope this doesn't happen, but Iran could say there's export bans, and then you could see the prices, or Iran or some of their allies could say there's export bans on oil or natural gas, gasoline, diesel. We could see big price spikes then.
Yeah, there's certainly more risk on the geopolitics side than there was, already, OPEC was sort of in the driver's seat, and I don't see that changing in the near term. We are finally starting to see some of these companies, at least talk about, in places like Europe, talk about doing some exploration work or increasing their capital spending. But again, it's going to be a slow process. And right now, BP, I think, is still talking about lower oil and gas production by 2030. It's just not going to decline by 25 or 30%, but it's still going to be down, and that's the last thing they need. And it's also why I think you're seeing more interest in nuclear power. Obviously, those stocks have been, moonshots this year, but that's it, right? That's a way of producing emissions-free, all emissions-free. See, that's another thing. I think a lot of people, the whole focus on climate and carbon dioxide, people forget about the other emissions that are the other environmental impacts from fossil fuels, and things like particulate matter from diesel, things like mercury from coal, and those are real too, and in fact probably have more of an impact on people's well-being than carbon dioxide for the foreseeable future. And so uranium and nuclear power makes a ton of sense. And so that's why you're starting to see that too.
Well, also, cheaper. Elliott, to add your points there from an economic standpoint, I mean, nuclear power over different cycles, it's also the cheapest form of electricity. So not just, so for side effects there for the environment and climate, I mean, also at pure economics, it can produce over the long term cheaper electricity.
That's right. And, a lot of people point out, in the US, we had some cost overruns, obviously, on the plants they've been producing in, or the Vogtle plants in Georgia. But, China has built tons of modern nuclear reactors in the last 10, 12 years with a 3 or 5 year construction timetable. We could do it in the US, or we could do it in the Western world. It's just, there's a lot of regulatory red tape. But I do think over time, it's definitely a solution, or a partial solution, to the world's energy mess. And, there is no one solution, right? There is no one,
I would say the solution is definitely not ESG, because look how much money's been wasted. It's all losses, right? It's is it trillions of dollars in losses on ESG?
I'm sure it is. I'm sure it is globally. Yeah. I'm sure it is. I mean,
but Al Gore got richer.
Right. And some wind and solar can make sense in certain places, but the idea that we can replace everything else with wind and solar, this sort of the maximalist view, if you will, the renewable energy maximalist view, to sort of borrow a term from cryptocurrencies, right, is just ridiculous, because it's just, there's no way that intermittent power sources like solar and wind can offset that traditional base load power that you got from natural gas, or coal, right?
Well,
And so,
look at Germany. Their electricity costs, like you said, it went to 40 cents from
yes,
cheap. So all their manufacturers, you had small businesses, manufacturers, they either had to close down plants like
yeah,
fertilizer companies and chemical companies, or they either shut down the plants temporarily, or they're moving. They're leaving Germany. That means jobs. The economy's in trouble if jobs leave the country.
well, yeah. I mean, it's funny because the other day I was looking on my Twitter feed, and there was a bunch of like environmental types, people, just stop oil type people that were sort of dunking that there was a story that came out that German energy consumption this year is going to be the lowest on record, which goes back to 1990, the reunification years, right? And I'm sitting there thinking, you all are cheering this, but it's actually terrible news. It's because the economy is going into a deep recession, and it's been in 3 recessions in barely 3 years. Right.
Exactly.
I mean, it's
That
not
means
good news.
those people cheering that, they must be trust fund babies or something like that. That means the German economy is in dire straits then. And we're
Right.
seeing the headlines the last 12 months when the electricity costs went up and the fertilizer costs and the natural gas import costs went up. The BASF, the manufacturers, I mean, they were either moving factories out of the country or they were shutting down the factories.
Yeah. They're going to relocate them to some place where they can make money, the US or just shutting down entirely.
Or
And
China. Yeah, I think
yeah,
BASF moved to China. Yeah.
yeah. I mean, and then honestly, it makes a ton of sense economically. And it's causing terrible trouble in Europe. For example, they're now importing a lot of refined products like, oil, gasoline and diesel fuel, because they shut down so much of their refining capacity. So where do they import those? Well, the US, sure.
Well,
Middle
that's good
East,
for Valero,
right?
right?
It's great for Valero longer term, sure. But also, guess who is one of the biggest exporters of refined products in the past is Russia, right? So,
And there's tons of sanctions. They just put sanctions on the new
yeah,
Russian liquefied natural gas facility. So, I mean, there's going to be less supply, at
right.
least to the G7 countries.
Right. And that's all that happened. I mean, I think there's also a misconception that when Russia invaded Ukraine, that global oil supply fell. It didn't. Russian oil production was actually higher after the war started than before.
Well, they sold to countries like
Yeah,
India and China, right? Because
that's it.
India was saying like, well, screw the sanctions. We need cheaper oil and
Right.
diesel and gasoline and stuff.
That's exactly right. So all they did, the destination changed, but the quantity, the physical quantity of oil didn't change. It wasn't the Russian invasion of Ukraine that caused oil prices to go up. They were already going up before that. And even more so for gas. If you look at it, and I wrote a piece about this on my Substack some time back, but the European energy price spike, as far as natural gas is concerned, started in 2021 because the atmospheric conditions were very unfavorable for wind and solar production. So they actually had a shortage of gas because their renewable energy reliance, caused them to need to burn more gas to offset the lack of power coming out of wind and solar plants.
It's funny you bring that up.
So,
I just looked at oilprice.com, and the main headline there is the German government has to bail out the Siemens struggling wind turbine division. I think they actually had to bail out the solar division too earlier a couple of months ago.
yeah, and another factor, and that's absolutely going to continue to be the case. Another factor that you're seeing is you talked about capital costs. Well, one of the biggest capital costs is to do something like an offshore wind facility, right? You have to spend all that money on turbines and offshore. And so a lot of those projects are being canceled in places like the US because they can't fund it without raising utility rates a lot. And states like New York are basically saying they won't accept rates that high. So they're canceling projects, and it's going to continue to be the case. And I often tell people when it comes to wind, you have to remember what I call the rule of 8, right? If the average wind speed doubles, the power output from a wind turbine goes up 8-fold. It's the cube, right? But if the wind velocity drops by half, then the power output from that turbine goes down by 87.5% to 1/8, right?
So it's not stable, not reliable. So if you're a
No,
manufacturer and you need stable electricity, for our listeners out there, if you're running a manufacturing facility, a large plant, you need stable electricity prices. You don't want the electricity prices going like a roller coaster up and down. You don't want that type of volatility. You want predictability, stability, so you can run your business and your input costs. You don't want things spiking or going up and down like that.
exactly. And you risk if, for example, let's say the wind velocity drops, there's a heat wave in summer, for example, and people are using their air conditioners more. And if the wind power drops, you have to have some sort of backup generating capacity to offset that. So usually what people use in places like Germany and also in the US is they use peaker plants, which are mainly done with natural gas, right? And a peaker plant is it's kind of like a jet engine attached to a pole, right? It's extremely inefficient relative to a baseload gas plant in the sense that it's much more expensive. It also emits a lot more, right, of all sorts of pollutants than a standard combined cycle natural gas plant. And if you don't have enough of those to feed power in, then your grid's going to destabilize and you're going to have a widespread blackout. And obviously, if you're a business or a manufacturing business, I mean, you can't handle very many blackouts before you're going to have, severe problems in terms of profitability. And one thing that they do in Europe is they do what's called euphemistically, right, demand management, right, which is a euphemism for literally the utility turning off your power, right, because they don't have enough supply on the grid for everyone.
Okay, so you're saying they're rationing then they're choosing between regular consumers, families, or small businesses versus manufacturers or government facilities.
They've put in place the mechanism for doing that since the Russia thing, because they know that all it will take is a cold winter. They got lucky last year, but if we have a cold winter anytime in the next few years, they're going to have problems. And so they've put in place mechanisms for literally basically shutting down certain users of power temporarily so that they can balance supply and demand. And a lot of people who are arguing for renewable energy as maximalists, saying that's all we need, they're saying, oh well, stuff like this is going to solve it, but I don't think the average person knows what demand management means. And it would be so awful.
These wind, solar, biofuels projects for the last 10, 15, 20 years, a lot of them have been so wasteful and so corrupt. There's trillions, there's at least hundreds of billions per country in losses. There might even be trillions. I don't think anyone's going to do accurate accounting of this number because a lot of the people that are getting paid to keep track of this, the consulting companies in the DC metro area, so like all your Deloittes and your Accentures, and those ones, Booz Allen Hamilton, those guys are pro ESG. So do you think they're biased? Do you think they're actually going to account and say like, oh, all this ESG spending accounted for trillions of dollars in losses?
No, they're not. And I think the only way that all this is going to change is because, the public is going to start. What's happened over the last couple of years is that because inflation is so high, the public, the average person, is becoming more aware of these issues. The average person may not understand, on the street, may not need to understand, what's going on, where the oil is coming from or how hard it is to get. But they certainly notice that their gas price goes up from, $3 to $5 a gallon. And, that's where you're starting to see some of these changes. In Europe last year, they spent billions in subsidies, right, to offset the spiking cost of electricity, because they knew that if they didn't do that, you were going to have people standing outside with pitchforks and torches, right, pretty soon, in the capital city, right, and you still had some of that, in fact, and I think you're going to see more of that until we start to see the level of investment needed to bring down the fossil fuel prices.
I don't think they want the investment, though. I think there's so many, like, I see just hypocritical stuff. I see these countries, Elliott, announcing we're going to build a very expensive liquefied natural gas importing facility, but that same country also has drilling bans on oil and natural gas.
Yeah, they do. And I mean, and Germany, for example, which we've spent some time talking about, what did they do? I mean, how did they get through last winter? They burned more coal. And not just coal, lignite coal, which is the most polluting kind of coal of all. It's brown coal.
Wood too. I think cellulose. Yeah, there was regular German people buying wood. They imported. They rented. I think very expensive. A couple floating liquefied natural gas facilities. So yeah, it was very expensive.
Well, because they didn't have any. I mean, that's the most amazing. I mean, that's one of the most amazing things in my mind is the Germans closed down all their nuclear power plants, right? Built all these wind and solar capacity, and were importing most of their gas from Russia. And they never thought that was going to be a problem, right? They never considered that maybe, having most of your energy come from one person, one supplier, especially if that supplier being Russia, right? Let's face it. Maybe that's not the best from a security standpoint. And, they rejected LNG import facilities where they could have bought gas from the United States, or they could have bought gas from Qatar, or they could have diversified their supply.
Or Norway, yeah. Norway is not far away from them.
Right. And they were saying, okay, well, we're just going to buy more gas from Russia, and if not, we'll import it from the Netherlands, who is importing it in the form of LNG. And finally, after this, it took that before they finally suddenly turned, 180 on the LNG import issue and authorized, construction of import facilities in record time, right? It's amazing what you can get done if you cut through all the red tape and just approve something, right? Without all the, years of environmental impact studies and all that. But, and until we see that investment, I think you're looking at higher for longer pricing.
Yeah, I agree. I think there's going to be higher price floors. In the short term, maybe oil prices go down a little bit. There's going to be less supply, though. I could see OPEC cutting more. So I know that's kind of, people aren't talking about that. I could see OPEC. I mean, if oil gets down to 50, 55, I could see OPEC out announcing even more supply cuts.
Yeah, I would not be surprised at all, because the difference is that in the past, for example, even back in the 2010 region, they realized that if they cut production, basically they were going to support the price, but then other countries were going to come in, particularly the US, right, and produce more and just basically take market share from them. This time they realized that pretty much no matter what they do within reason, US is not going to take much market share from them, right, longer term, because we can't. We don't have the ability to grow that fast.
Well, we already did the growth, right? So the U.S. already got back into the top 2 or 3 for oil production with the Permian, but there's not another rapid growth percentage Permian.
Right. And Permian itself is maturing, and companies like Exxon are not interested in growing production at 20% a year. They're interested in, as I said, sort of a plateau, longer term, growing to a longer term plateau. And and so they can actually cut production with impunity, whereas in 2014 it was exactly the opposite. If they'd cut production in 2014 to support the price of oil, they realized that the U.S. was just going to produce more, and they were basically subsidizing the U.S. shale industry.
Well, they actually did the opposite. I know you know this, but the listeners might not remember this. So like about 10 years ago, they actually increased production because the goal was to flood the market with extra oil and bankrupt a lot of the shale companies.
Yes, and that's exactly what they did. It was the head of OPEC, or the energy minister for Saudi Arabia, Ali Al-Naimi. Actually, he wrote an excellent book about his whole career. It's very interesting reading. But he saw that what was basically happening was the oil demand growth was pretty strong, even though prices were high in that 2012 to 2014 region. But the U.S. oil production was growing very rapidly. So Saudi Arabia kept cutting their own production, and to keep the price around $100 a barrel, because that was a comfortable level for them. And every time they did cut production, other OPEC members would start producing more, and then U.S. shale would fill the gap. And so there would be downward pressure on prices, and they would have to slow or cut their production again. And so they realized that this could carry on. And I don't know if you've studied it, but they did the same thing in the early 80s, and they did the same thing in 1986, where they flooded the market with oil to try to, put the squeeze on producers that were oversupplying. And it worked, right? Over time, it basically squeezed the whole industry, and you had the shale producers still growing, but it was harder for them to make money. It was harder for them to grow at that rate. And ultimately, it led to a switch in the shale industry where companies started targeting free cash flow rather than, naked production growth at any cost. But now it's the opposite issue. They don't have to worry about so much growth outside the non-OPEC production growth, because there just isn't capacity for it. U.S. can grow, but it's probably mainly just going to offset, as we discussed, some of the mature fields elsewhere around the world. There are no major global oil projects other than Guyana. They're going to come on stream rapidly, in the next year or two. There's some promising prospects in places like Brazil, but it's going to take many years to bring them into production.
But
and you still have the Western governments.
Let me interrupt you for a second there with Brazil. Let me add your points there. So we're also seeing a large pushback from the Brazilian government. They want Petrobras, who has a lot of free cash flow from those ultra deep water wells. They want them allocating tons of it to ESG and then paying larger taxes and funding social programs. So they're not going to be able to invest as much in future oil production growth because of government policies in Brazil.
Yeah, and it's the same. Honestly, it's the same everywhere. As we discussed, whether it's an overt restriction on, developing new fields, for example, in the North Sea, or whether it's just a hostile environment for CapEx, the effect is the same. You're not getting enough investment. And, while your Western countries are talking about, ESG and climate change, Saudi Arabia is, rubbing its hands together, investing in new oil and gas production. And they know that that's going to be needed. And yeah, I mean, I keep going back to but that's going to be the problem.
Well, and the Saudis and China are doing large deals. The Saudis are building a large fertilizer facility, petrochemical facility, refining facilities in China. So they're like co-deals. They're building pipelines there. So they know that that's one of the main sources of future demand growth. I've kept you for over an hour, Elliott. I think we could discuss this for another couple of hours. I don't know if the listeners would want to listen to this. One more question before I let you go, though. On the deepwater offshore Guyana well, so you said that these are super low cost wells. Are these also like low depletion wells? So these are like the best of the best, the creme de la creme. So in terms of cost and low depletion?
Yes. The thing with these conventional wells, like in Guyana, almost all the investment is the upfront capital. The operating costs are very low. So it's kind of like you put billions of dollars into the project to drill the wells and build all the infrastructure, and then after that, the operating costs are very low. You can break even at $25 or $30 a barrel Brent, which is lower than I think you'll see it in the foreseeable future by far. I don't even think you'll see 50s this cycle again. But anyway, your operating costs are very low. Additionally to that, when you find new fields in the same area, you can do what's called a tieback. So what that is you drill the well, but you don't have to build a brand new floating platform and all that infrastructure. You can just use a subsea pipeline to connect it to your existing infrastructure. So the more infrastructure they build, right, that investment gets spread out over a larger base of production. And so their costs are very low. As far as depletion rates, all conventional oil fields deplete. The biggest risk is mismanaging them, for example, which they did in Mexico, for example, where you try to produce it too fast and then you end up killing the productivity of the well.
Oh, well, Pemex is corrupt. Yeah, it's not efficient. It's wasteful and corrupt. Yeah, there's tons of examples of this.
Yeah, and they used tertiary recovery techniques and whatnot, flooding, to try to produce their fields faster, and it did produce faster, but then it also depleted faster. Russia did the same thing in the late 80s. They were desperately trying to kind of hold on to the whole Soviet. This was during the Soviet era, and Samatlor, which was their largest field, was depleted very rapidly and mismanaged. But Exxon and Chevron don't do that. They use very careful management techniques to make sure they're not overproducing field, that they're kind of optimizing production from the field because of a life cycle. They want to get as much oil out of it as possible for as long as possible, maximizing their production rates and their cash flow. So in that case, when it's responsibly managed like that, these fields can produce at a plateau rate for many years, 10, 20 years, quite possible to produce a well at a good plateau. And so it is an amazing asset. It's a gem. And Exxon is a great operator, obviously. So they're able to do this. Again, though, there are so many other fields around the world that are mature that a lot of what they're going to be doing in Guyana is just offsetting declines elsewhere. And that's the problem. Every year, the established base of global oil production, what we call the base decline rate. So it's a few percentage points a year. Mature fields lose a few percent of production every year. Some people think it's as much as 5 or even higher percent every year. The existing group of fields all over the world sees a 5% drop in production. Now that has to be offset in order for the global oil production to grow. So the problem is that there isn't enough new production coming in to offset all that base decline everywhere around the world and grow production beyond it. It takes a long time to reverse that. In the 70s, it took a decade. This time, technology means that you can probably theoretically develop certain wells faster, but the wells we're developing now are much more complicated. On top of that, we're not investing. So the commodity cycle in some ways is broken because, and a lot of that has to do with what we talked about, this government policy discouraging, oil and gas
for
companies.
Energy. Yeah, especially for energy.
Right. Look at it this way. The S&P 500 energy index, it's got a less than 5% weighting in the S&P 500. At the lows, it was 3.5% weight in the S&P 500. I'd argue energy is arguably the most important sector of the economy, because without energy, the economy won't even grow. You can't have Apple without electricity, right? So
you can't have anything without diesel. The entire supply chain, grocery store,
right.
Driving to work, getting food at the grocery store, even having food in the shelves at the grocery store, anywhere else, all that relies on diesel. The average person doesn't think about all the effort required, where the electricity comes from, how much diesel is used just for them to go to the store or to buy groceries. It's truly shocking what the average person doesn't understand about basic stuff like that.
Exactly. And, if you look at it this way, you have 3.5% of the market of the S&P 500 or 4% of the S&P 500 trying to finance this enormously important industry. It doesn't add up. These companies have to be more valuable than they are today in order for that industry to have enough capital, access to capital, to actually do what they're being asked to do, which is meet global energy demand. And so
Oh,
in my
I
mind,
agree with you. You're preaching to the choir, but I hear a lot of the oil bears. I'm short oil. There's too much supply. Demand's about to collapse. Well, maybe for a few quarters or something like that. If the oil price goes low enough, OPEC's going to cut. A lot of supply is going to be uneconomic. You're going to see, like you've been saying the last hour plus, big supply issues. There's long-term supply issues, and the U.S. right now is exporting a lot of that oil, that gasoline to other countries. Well, if that supply is not economic, if oil prices go lower, there's going to be even worse supply issues. And then on top of that, there's not the investment needed to replace the depleted supply, like you said. So there's all types of supply issues long term.
yeah, and and the Saudis can do what they've done in the past, which is if they feel that there's too much short speculation in oil, they can unilaterally cut production by 1 million barrels a day for a month and squeeze everybody out of the market. And they've done it before. One day in April, I think it was April, maybe late March. I mean, oil prices were up 10% in one day because they did that. It's not, yeah, the idea that there's too much supply long term is insane. All you have to do is look at go out and look at the U.S. oil inventories. The numbers reported by the EIA. And you'll see that U.S. oil inventories right now, commercial oil inventories, are below the 5 and 10-year average. So it's already a tight market. Cushing is at the lowest level nearly on record right now.
And that's in the US, and we have a lot of oil supply. It's even worse in other countries.
And it's worse than that in the US because if you would historically, we always, ever since I've been studying the industry since the 90s, right? We always looked at weekly inventory numbers, excluding the Strategic Petroleum Reserve, the SPR, because the Strategic Petroleum Reserve was like a government-owned stockpile for emergencies. Okay.
Yeah, well, that changed.
Yeah, that changed. So now the SPR is the same size it was in 1983 or 84. And we've sold all this oil out of the SPR. We're not replenishing it. And so if you look at actual US oil inventories, total oil inventories, they've been plummeting for, ever since late 2021. Because not only is supply inadequate, but they've tried to offset the inadequate supply by selling off government stockpiles of crude, perfectly timed for the midterm elections, if you will. But at the same time, right, now we can't sell any more oil out of SPR because it's already, heavily depleted. So, it's going to be even worse in future because we're not going to have that, extra source of supply to sort of, paper over the underlying issue. I think the world is a lot tighter on supply than almost anyone realizes. And I'm not even sure that in a moderate type of recession scenario, if you're going to get enough of a demand drop to really loosen the market for any length of time. And like you said, I think it's quite possible, even likely, that OPEC will take action. In fact, this month in November, early November, they announced that they're going to maintain their cuts through the end of the year, which was expected. But at their upcoming meeting right at the end of this month, they're, I suspect, going to talk about potentially extending the cuts into 2024. And I'm not even sure they have to cut more. I think they could just say, you know what, we're going to extend it through, the end of next year, right?
Well, I think the cuts are just a press release. So the algorithms that are shorting oil, the hedge funds and trend traders that are shorting oil futures contracts, but in terms of the actual production quota numbers that a lot of people don't talk about, I mean, most of the OPEC plus countries, Elliott, are not even hit anywhere close to their production quotas. They've been missing them, like consistently missing their production quota guidance for a long time.
And their production quotas are fantasy in many cases because they're based on oil production years ago. And in some of these countries, they've been in decline so long, like Nigeria, for example, their production quota has very little resemblance to reality. They're basically producing flat out, right? But their flat out production is declining. The only countries that you really need to look at are Saudi Arabia, Kuwait, UAE. These are the Gulf guys, the Persian Gulf producers. These are the ones that actually have a history of actually being able to raise and lower their production and actually following through on their agreements to do so. Russia, honestly, I think that some of their problems are not, they're not really cutting oil production so much as they are unable to sustain their existing production. Obviously, they've been cut off from a lot of the services, technologies, and investment that you need to sustain a field like many of their fields in Russia. So I think that the only countries in the world that have real spare capacity are Saudi Arabia, maybe a little bit in Kuwait, and a country like United Arab Emirates. But the idea that there's a ton of spare capacity in a country like Venezuela, again, it's fantasy. I do think that if they ease sanctions on Venezuela, Chevron can probably go in there and produce another 100 or 200,000 barrels a day. But remember, it's a 100+ million barrel a day oil market. That's a drop in the ocean. Hopefully not literally.
Well, the depletion rates you mentioned, I mean, on the oil production, I mean, the depletion rates are starting to really accumulate now in those older fields. So like with Cantarell, and the Saudis do have new oil production, but it's not the cheap stuff that was $10 or $20, $30 a barrel at Gue. So there is more oil supply available, but the days of like $10 to $40 or even $50 a barrel oil, I mean, those are declining. It's super rare to find something as good as the deepwater offshore Guyana now.
And even that, at 20, even $25 or $30 a barrel is a higher cost than the field like you mentioned, Gue and Saudi Arabia, which has production costs of under $10 a barrel.
I don't believe that number anymore. I've heard it's closer to 30 or 40. So I mean,
well,
it's like
they're definitely producing some areas that some regions of various fields that are higher cost, and they're not fully, they don't disclose all the information on the field level for national security reasons. But the point is that 20 years ago, 30 years ago, their production costs were $5 a barrel in some of these wells. And now they're turning towards what's still considered, $25 or $30 a barrel in today's world is still an extraordinarily low cost of production. Pioneer's break even in the Permian is around $30 to $35 a barrel. That's really low cost. Some of these wells are 50 and up, right? And the world isn't running out of oil as much as it's running out of easy and cheap oil.
Exactly. And the deep water stuff or Canadian oil sands, that's much higher cost, especially deep water. I mean, deep water, you're looking at, it's not economic below 50. I mean, at least 60, 65 in a lot of the deep water wells.
I think even for, Guyana, Exxon probably wouldn't go ahead with a project like that if oil prices were expected to be, $35 or $40 a barrel long term, even though they might theoretically be able to make a, free cash flow on it. That's not enough of a return for a company like that. But I mean, I think that their bet, which I think is kind of a no-brainer, is that over the long haul, oil prices are likely to be above $25 to $30 a barrel. So, probably average, considerably more than that.
I think we're looking at higher price floors, $60, $70, $80 a barrel over the next 5, 10, 15 years, because I just don't see cheaper supply available to offset the depleted older fields.
No, and I think in a normal environment, a normal economic environment, Saudi is going to want to have oil prices over 90 because that's what they need to balance their budget. And Saudi Arabia, remember, a lot of their government budget is subsidies and social spending because they have to keep the poorer elements of their population happy so they don't revolt, right? So it's kind of a necessity that they spend that money. And even when they try to, for example, lower the subsidies on oil and things like that and gasoline, they have, unrest. And so Saudi Arabia wants to balance its budget longer term. Now, that's not to say that they can't borrow money or whatever for shorter periods of time, but longer term, I think Saudi Arabia is going to want prices up around, that $90 a barrel plus range. And, they're going to be very cognizant of the potential for high prices to cause demand destruction. So you can certainly see dips below that level for prolonged periods. But longer term average, I would say, 90 is probably a good 90, even higher is a good marker. And don't forget that costs are going up too, just because of general inflation. Producing oil requires a lot of energy, right? Diesel, etc. So that cost is going up.
Labor
Steel,
costs.
labor, yep. And that
And
labor is
now,
another big problem because a lot of the older guys who were working in the oil shale, for example, experienced, hands. They retired during the bad years, and
and
it's going to be very expensive to get them back.
And now you've just added in much higher cost of capital with interest rates, because now the alternative is to go and buy quote unquote risk-free treasury bonds at 5% or the 10-year US treasury yield, which a lot of corporate debt borrowing and a lot of capital for the private sector is priced off the 10-year US treasury yield. If the yields on that are 4.6%, or they were almost at 5, I think a couple weeks ago, but it's still right. 4.6%. I mean, the cost of capital priced off the 10-year US treasury for debt and equity for a private company is going to be very high.
Oh yeah, and the old T-bill and chill thing, right? For investors, where if you can earn a 5% plus rate of return, risk free for doing nothing, basically not taking any risk, everybody else is going to have. If you want to earn a higher return, you're going to have to offer a higher return to take on additional risk, a lot higher. And I don't even think we've seen the half of that yet. We haven't even seen. For example, the junk bond yields explode out, the spreads explode out to what we typically see, in a recession. So there's probably a lot more reckoning to come on that front as well.
But I think the point Elliott and I want to make as we wrap up here is that with cost of capital interest rates where they are, that will even further restrict a lot of commodity supply, especially oil and natural gas, and these longer dated investments that the oil and natural gas companies need to make to bring on production, because the capital is much more expensive. So if you're a smaller or medium-sized company, your cost of capital is going to be way higher than an Exxon Mobil, a Chevron, or a Saudi Aramco that has much cheaper cost of capital that can actually borrow or wait out some of these higher interest rates, or they'll just subsidize some of it and make some of these longer term investments expecting higher prices. The smaller and medium sized companies can't necessarily do that.
That's right. And that's why you're seeing more. That's why you're going to see more consolidation.
Exactly. So we're going to see supply side problems depending upon what the Fed does with interest rates. That's just the newest thing here on the higher costs and input capital. I guess higher cost of capital would be inflationary, not the traditional inflationary that economists would say, but the input is definitely causing input costs up.
Yeah, it's not as easy as I mean, the idea that simply by raising interest rates you can certainly engineer a recession, which will bring down inflation, right, in the short term. But the idea that that's the only source of inflation, especially on the commodity side, I think is incorrect. I think that's the sort of an incorrect remembrance of history, if you will, right? Oil prices.
So central bankers can kill demand, right, by raising interest rates and cause a recession, but they're inadvertently, it's like collateral damage. They're also killing supply then.
They're killing investment, right? And also remember, in the 70s, one thing we learned is you can hike interest rates and create a recession like they did from 1973 to 1975. And some inflation will come down, even though oil prices did not come down over that time. And actually, no commodity prices did. Obviously, gold was up a lot as well. But and inflation will come down, right? But if you then lower interest rates because you're trying to target growth, it's very easy to reignite inflation, which is what they did in 74, 75. And it carried on, through the end of that decade. And then you end up in a situation where you have very volatile economic growth conditions, rising unemployment or high unemployment, and very high inflation. That's a real risk this time around as well. And once you get to that, it's very difficult to get out of it.
Exactly, especially with the budget deficits DC is running and the national debt rapidly growing, interest payments on the national debt taking up so much of tax receipts. We don't have time to discuss financial history, but let's just say I don't think the people in power are going to allow deflation for a long period of time. The higher interest rates are going to collapse too much the real economy and tax receipts. The Fed is going to reverse course in the not too distant future. I don't know exactly when. I'm not betting on timing of this, but I think oil and energy plays, non-ESG energy plays, oil, natural gas, uranium, coal. I think there's a lot of opportunity there because of all the stupid policy mistakes on the supply side, because I don't think demand is going to zero like the Davos crowd and the ESG people are claiming.
Yeah, I agree. I agree with all of that for sure.
Well, Elliott, we've gone for over 90 minutes here. I really enjoyed our discussion. Let's plan on having you back on it again in a couple months. Thank you so much for your time. Sounds like Exxon Mobil and Chevron, their shares were beaten up substantially in the short term, but they made some smart long-term decisions.
Yeah, I agree. Exxon particularly. I mean, I was, getting down to around $100. I think that's a great value longer term. Their deal to acquire Pioneer makes a ton of sense. The assets of Exxon already had and Pioneer's assets just fit together hand in glove.
And if my listeners want to take a look at your newsletters, take a look at your Substack, how did they do so?
So the newsletter that covers energy is energyandincomeadvisor.com. So you can go there. If you want to look at some of my commentary, I write a lot about energy, but also economy, the stock market, over on my Substack. That's absolutely free. It's freemarketspeculator.substack.com. I publish twice a week on Tuesdays and Thursdays. Sometimes I put up a bonus post, and that's entirely free. The cost is your email address, I suppose. I do a lot of commentary there about, oil and gas. And in fact, had some articles covering some of the topics that we discussed today, including the recent mergers, as well as some of the ESG topics we covered today.
And I want to thank you again for your time. This is over 90 minutes, and this was a masterclass on oil and natural gas investing.
Well, thanks for having me on. As always, I enjoy it.